The big question that hangs over this, and maybe you've addressed this, is there, in this confusing world, a systemic problem in which the entire system is somehow fragile and could collapse? And has it become more severe as complexity has grown? Have you addressed that question yet? Because I think one of the big things is you think you have, and you probably mentioned this, you have 14 exchanges, right? You have 40 dark pools. You have bilateral trading agreements between companies. Each one of those under regulation M&S has to be connected to one another. The question is, does all that complexity lead to a point where we really could have some sort of systemic failure? And if we do, could there be negative consequences that are really quite traumatic for the capitalist structure of America if that unfolded? So can I get this to the panel to address that?
If I could come in there.
Yeah, sure.
We did a study recently using the London trading environment, basically looking at the 4 main stock exchanges in the City of London, the London Stock Exchange, Chi-X Europe, BATS Europe, and Turquoise. What we're trying to do was look at how the fact that the market has fragmented over a period of a decade from 2004 to 2014 to see how that has impacted market quality. And we find that the situation that London finds itself split, trading split among mainly just 4 markets, it's not too difficult. It has actually helped improve market quality. We find that the competition for order flow is pushing down, reducing adverse selection costs, and as a result, it's making the market more it's helping improve market quality characteristics. But having said that, I understand that the U.S. Trading environment is a lot different. You've got about 60 different exchanges, and that's a different ball game. One thing we also find is that there's a quadratic relationship. There's this sort of U-shaped relationship between market fragmentation and market quality characteristics, whether they're improving or decreasing. So my guess is that in the U.S. trading environment, we've probably arrived at a point where market fragmentation affects the quality of the market.
Let me just follow up on this. So one of the issues is if you have a lot of competition between markets, you might get better pricing, you get more efficiency, but you also get more complexity. And the question is, in the multiplicity of sites that you have that produce this virtuous outcome, are you also embedding vulnerabilities that could be tremendously disruptive and damaging? Do you think that's possible in the London markets? Do we think that's possible in the U.S. markets? I would appreciate a panelist weighing in.
Can I make 1 or 2 points here? One is that I'm not necessarily convinced that everything that's going on the exchanges is actually about trading. There are people who actually are investors, and they buy and they hold. So maybe my qualification would be is that I think there are a lot of people out there, long-term investors, who just go and buy, and they just want to make sure that they have a fair price when they buy. They're not necessarily trying to basically flip it within 10 seconds or 2 days or whatever.
Makes it particularly difficult for them if there's a huge disruption when they're in that process.
Well, they're not trading very often, so it's not necessarily the same case. But secondly, the thing is that your comments seem to be almost all focused on the U.S. equity market. And the structure of the U.S. equity market is quite different than what you would see in the FX spot market or in the U.S. futures market or in the U.S. government bond cash market, where you're looking at something that is not really strung together under the SEC's Reg NMS. I would tell you that, in fact, it's kind of interesting to look at this because over the years, things have actually, the volumes have increased. Exchanges are being described as being technology firms now. They have to be better at doing things, and they've done quite an incredible job, even though you read about exchanges having problems in terms of delayed openings and things like that from time to time. Certain markets have done extremely well in high volume, even though they have big market moves. For instance, the company I represent owns BrokerTec, which is the largest U.S. government bond trading platform cash-wise in the world. And while there was a huge move in October of 2014, it was a 15-minute period where there was a huge up and down, Thing is, though, is that all the trades were done. They were completed. There was not a mechanical breakdown, even though we had volume that was 3 and 4 times what you would normally see in a particular day. So is electronic trade, and most of the trading is done electronically there. Did we have a failure because of the electronic trading that was going on? No, everything happened. But people are always concerned about volatility. They don't like big price moves. Well, the answer is basically, in this market, sometimes that happens. Sometimes you don't have the market makers step in and take a kick in the teeth, as it were. But the thing is technology, electronic trading is not necessarily leading to systemic breakdowns.
Well, so you raise an interesting point, because that event is one of the events that's been studied quite a bit. Why was there this huge disruption in pricing in the government market? I mean, there's this tension between, what the value of something should be and whether the traded price for it reflects that value, and if it's somehow disrupted in some sort of odd way. And one of the curious aspects of many of the disruptions over the past 5 or 10 years is we don't really understand why they happened. I don't know if you brought up the flash crash before I came in, but the flash crash, where prices plunged precipitously over a very, very brief period of time, was initially ascribed to a mutual fund trader with a fat finger or something like that. And now we've seen a man arrested in London who lives in his mom's basement or something and trades shares. There was a full SEC report that came out in 3 months that described it for one thing, and now it's perceived to be something else. When you had that old system of specialists, I guess one virtue you had is you could walk over. What?
You just stop trading the stock or the
You could just stop trading the stock, and you could just walk over and say, what the hell happened, right? We actually don't know what has happened during many of these really though the system functioned. You brought in these other markets. I'm actually quite curious. Do you trade on the equity markets too, and do you have any relative, the equity markets do get all the attention, they get all the studies, they get all the whatever, and I have no idea if they function, better or worse than these other markets that you're engaged in.
I think the answer is it depends. There's a lot of differences in liquidity. You'll see moves across, the FX market that you perhaps wouldn't see, in individual stocks or indexes. But now, Cantor Fitzgerald's a big ETF player, and the ETFs are now bridging all these different products. You have international ETFs, country funds, bond funds, high yield funds, and the underlying instruments behave the way they behave, but ETFs trade like stocks. So there's a convergence to stock-style trading, even in these other instruments, and you'll see behavior characteristics that'll start to merge over time, which is a good thing because you can get more things done. It's a bad thing because now perhaps you'll get moves that you wouldn't have gotten in the past because certain instruments will perhaps get more play than they should. And the analogy is if you have an index that is sort of outweighing a couple of the different individual components of that index, if you're a company in the S&P 500 and your stock is down day after day because the market's being sold, and you may not be that happy about that if your fundamentals are good. So at some price, people will step in and buy your stock, and it'll trade back up. But I think there's a lot of layers to this in terms of market participants. We talked about mutual funds, long-term investing. They just want to get a fair price when they enter. But if you didn't have any short-term players, they wouldn't be able to fill in the blanks and match the size of the order that you're trying to trade. So every player has their role to play, even with the long-term investors and the shortest of the short electronic trading firms, and it all blends together to show liquidity. But your point about the flash crash, we saw an example of this past August, right? In 4 days, the S&P was down 12%. You had an opening where stocks were at levels where they actually didn't trade later that day, so you had real market disruption. And I think the level of where you're setting your circuit breakers is perhaps more important than the style of the electronic trading. So